Disclaimer, this is not financial advice. Nau mai e te ti, nau mai e te tā, nau mai hoki mai ki tēnei pāpāhotanga o tātou o tino ki tō tātou taonga te reo irirangi o Whanganui Awa FM. 7 minutes past 8 on your Tuesday morning, and we are back with Money Mondays with Uncle Rich. However, it is on a Tuesday. Morena, Uncle, how are you?
Morena, very good, thank you, very good.
All right, ready to rock and roll. What are we talking about today? And a little bit of a refresher from last week.
Yeah, ka pai, kia ora noi te iwi. So this week we want to talk about investing. So it's sort of the next carry on from KiwiSaver. Yeah. You'll notice a lot of similarities, and then I want to go over the whys and the differences and why we do this and why we need to be investing really. This ain't about making you a stock market whiz or picking the next big thing or whatever that is to you. So it's just talking about the investing more broadly. What are our options out there? The risk and reward, how they work together, and some of the classic sort of mistakes we may be able to look out for. So.
Nice. Before we jump into investing, last week we unpacked KiwiSaver, which was really good. How it works, why it matters, and ways Whanganui can make it work harder for their future. For anyone who missed it, what was the one thing you wanted people to take away from that kōrero?
I think it's really just to check your fund. That was it. It was just be aware of what fund you're in. Have a look at your fund, have a think about your timeline, and then go from there and look at the returns and so forth. Just do a bit of homework. That was the biggest thing. Be conscious, because this is, again, going to be one of the biggest investments you have over your time, because if you've used it for your first home or if you're starting out, you've got 30, 40 years. Like this could be a big chunk of change, so it's important to get it set right early.
And just an FYI, Tiwana, we did some mahi te kāinga yesterday. Uncle said, hey, let me check out your KiwiSaver. Let's go from there. What is the fund? What is the percentage, etc.? Who am I currently with? So we were with Fisher Funds. And then Uncle sent me a beautiful email yesterday saying, Milford sounds like the go for you. And it was a matter of, I would say, I probably spent 5 minutes checking out their website, having a real good read of their kōrero, and then it only took me about 1 minute or 2 minutes just to change over. And we did that simple. It was very simple and straightforward. So, looking forward to see what Milford has to provide for us. And we'll really get into it. It's well, if you have any pātai, those who are online tuning in, Namahi o te ata ki a tātou. If you have any pātai, please chuck them in the comments or send us or myself or Uncle a private message, and then we can get into that. So let's get in. Why bother investing at all?
Yeah, and I think it's a good time, Happy New Year, all that sort of stuff. We can start fresh. We're talking about our goals and aspirations. But the reality is, if we've got money in the bank today, it's actually losing money just because of the way inflation is at the moment. You're not getting a good interest rate in the bank. Inflation's running, well, we're waiting for results, but it's at least 3. So we're not getting that, just money sitting in the bank. So we need to start looking for other ways to grow our funds, and investing is one of those ways to do that. So it's essentially putting it into a market so it grows faster than it's being eroded. I think that's the biggest thing to take away, or one of the big things to take away today is the why. And we're talking about the long game here. We're not talking about your savings account. That's different. If you need this money in 6 months or a year or so, that's different. That is good. That is a savings account. But we're talking about long-term growth here, investing for the future, all those sort of things. So,
And that's a real good distinction between savings versus investing, right? How should someone know whether their money should stay safe in savings or whether it's ready to be invested?
It's money you don't really need right now. That's the thing. Or it's not earmarked for anything. So if you're doing something in a little while, a trip, a car, or whatever that is, what you've been saving for, leave it there. That's okay. That's okay, because just don't expect you're not going to get the returns that you need. So if we move it over here into an investing platform or something like that, there's different products and so forth. So that's what I'd say.
Okay, now we're moving on to risk and return and the core trade-off.
And this is a really, really, really important concept to get our heads around, because the higher the risk, obviously the higher the reward. A really cool way to think about a dial or something. At one end, you've got low risk, low return, So then, but when you turn it up, you're getting higher risk, higher reward. And those are the trade-offs that we need to consider when we're going into these. The higher the risk, it's normally more speculative. So there's really more risk of your money losing money potentially. Going up and down, being a bit more volatile. Like we said in our KiwiSaver, your money could be going up and down. If it's in the lower funds, it's more smoothed out, and it'll be more, it'll just go up in a nicer fashion. If you put it in a high risk fund, you're looking at that it could be a bit lumpy, it could be a bit bumpy along the way. So we're thinking about, again, what I said, the hot tip.
Yeah.
We're talking about putting all your money against one stock as an example, or one company. You're talking about those sort of things that create the risk that may, go. I think, like I said last week around your KiwiSaver, it's sort of your own test. Have a think about what it feels like if that dropped by 20%. If that dropped by 30%, how does that actually make you feel? Can you handle that?
Yeah.
And then trying to work out what your risk appetite is from there, and then you set the investment accordingly.
Yeah. Now, pai tērā pātai, uncle, about losing sleep, because that makes risk feel a bit more real.
Yeah.
Makes a bit more real. For someone listening who's a bit nervous, is being a bit cautious, or it's maybe a bad thing, or that can actually, is it a strength or can it be a bad thing? Like, what's our take on this?
Oh no, I think it's a positive.
Yeah.
You've got to be engaged. You've got to be engaged in this stuff. If you didn't feel anything, that's just pretty much, chucking it out there, having a gamble, red, black. You've got no, feeling for the actual investing you're trying to do. Whereas if you're actually made an educated guess, you've had a look at the results like you did the other night, just having a look going, oh yeah, okay, this seems pretty solid, reputable company, all those things that come along with that, you'll make an informed decision. It takes away that sort of risk and worry. But yeah, that one I think about is just thinking about how does it make you feel? If it dropped 10 grand, are you going, oh, I need to make a change, or it's all good, I understand the ride, this is why I'm in this fund?
Yeah, and that's what happened during COVID period, right? And what we're seeing now with our KiwiSaver is that it's dropping, but we're probably feeling that, but we're not actioning anything behind it.
Yeah, just like live in it,
have
a look at it and go, shucks, this is what happened last time, look what's happening again overseas, the war's back on apparently, so you watch what happens to different things in our world now. Things will go up, things will go down, like your funds will go down, prices will go up, and you'll just be like, oh, I'm starting to understand this, I'm starting to see the economics of how this works. So it's good. It's good for us to learn.
Absolutely. And what I've been enjoying throughout our whole series, and particularly investing, so a lot of our people and a lot of my generation are investing. They're very clued up. And some of us aren't, so this is an opportunity for us to ask the questions, or maybe we're thinking about sharesies or something, so that's probably the prime time to ask these pātai. So we're getting into the main asset classes, and you're giving us a quick tour.
Yeah. Just a quick tour of some of the main asset classes, and these are just what you're invested in. Okay? Don't get complicated by the words. Main asset class, your asset allocation, all these things. These are just the classes. So start with a simple one, the share. So a share is a small slice of a company. You are literally buying a small slice of a company, and that price can rise, that price can fall, but it's just a portion of that company that you're buying. That's what shares are. As such.
Great.
Bonds are a little bit different. Bonds, you're actually like lending money to a company, and then they will say, I'm going to give you X return interest for a period, and that may be 12 months or whatever, and then that'll happen, and you'll get your money back as agreed at the start. So bonds are good. Bonds are pretty safe. Property, everyone's talks about in New Zealand. It's one of the biggest ones we do in our country. It's investing in rental properties. Obviously, you need a bit more to get into rental properties, so there's a bit more mahi involved in that. So the in is out, and then it's not as liquid as well. It's not as easy to turn it into cash if you need it. So property is actually, it's a really long-term investment that takes some real serious planning and so forth to get into. But hey, still solid investment. Good compulsory savings, as I say. And then probably the one that I most sort of is around the managed funds situation. So think of managed funds like your KiwiSaver.
Yeah.
Okay, so it's the same thing. It's a fund. KiwiSaver is in a fund. It's a managed fund. These are funds. You can have the same setup like growth and balanced and all those sort of nice. The beauty of these ones is it's not locked away. So you have the opportunity to put money in here. Like we have one set up for us, and we just put in a weekly amount.
Yeah.
We just let it do its thing. We put it in a high-risk, aggressive fund because we don't need that money long-term. And we just put in a payment, and we just let it go.
Yeah.
We just leave it there. Now, if we need that money, we can easily go in and get it out.
Yeah.
And that's the beauty of these funds that are here for us. I think the only way to think about is KiwiSaver is so important because you get all the other stuff, the income and those sort of things. These ones have got your money plus interest. Okay? But most fund managers, providers now do it. So be aware there's plenty of them out there, okay? So these are the things you'll hear: managed funds, index funds.
Yep.
That's the sort of chat you'll hear. And probably one of the safest ones is term deposits. So term deposits, you'll see them advertised all the time on TV, on the banks and different things. And it's like, hey, give me your money for 12 months and we'll give you 4% return or something, whatever the number is at this time. So that's probably one of the most secure ones. This is what people do with a lot of cash.
Yeah.
You know, if you've got a lot of money, these are the ones that do it because it's an actual return. You let them have your money for that period, whatever the days are, and then we go from there and you get your money at the end. You can reinvest or obviously take it away. Key point across all of these ones, though, is that none of them best in isolation. You know, like we got to have a look at. It's a mix. It's all about your goals. It's about your time frames. It's about how much risk you're comfortable with. So these are just some of the main, like I said, main classes, asset classes that we've had at the start.
And I think it's a pivotal time now. Matariki, Tauhou Māori, we're into a new year, so we're resetting our why.
Yep.
Let's do the same for our putia, Andy.
Yeah.
Hey, it's simple as that, Te Whanau.
And like I've said from the start, it's just been about conscious. You know, being conscious of what we're doing with our putia, where our KiwiSaver is, what we're doing with our savings, what we're doing with our investments. Don't have to make big, massive shifts, big, massive changes. Some simple shifts here. And like we'll talk about our actions for the week, some simple shifts, and you'll be like, he said that last week. And you'll be like, yeah, you know why?
It's the same thing. It's the same thing. All right. If someone is brand new, you know, all those options can sound like a lot.
Oh, yeah.
Where would you suggest they start learning first? Shares, funds, KiwiSaver settings, or just understanding their goal?
Yeah, I think it's a good time to talk about sharesies.
Sharesies,
like my personal view on it is people are using it, and props where props are given. They have changed the game. It's well known now. Tons of people have these accounts with them, so they've done a great job of educating us, and that's the best thing about the platform. It's simple. There's no, low cost to get into. What can you start with $1? Hey, there's no things. The trick with sharesies is they are doing it great in terms of you getting out there, having a test bed. Just my personal view, this is just me. It feels like the people that I talk to and the stuff here, it is like a game. It's getting a bit gamified. We're like, we're doing this, I'm doing this, and I'm putting it over here. And we're like, okay, cool, that's great for knowledge building, great for knowledge base, and that's what we're talking about. If we've got people that are going, far out, where do I start here? What do I do here? You can go in there. Easy to set you up an account. Go and put some money in here and have a go. The trick again is coming back to these ones, is understanding all those things, your timeline, your goals, your risk and reward. And then the kicker that gets me is the fees. So just be aware and make calculated choices around the fees that you're going to be charged when you go into these funds, because some of them you need to buy in. And then some of them, then when you get out, you want your money out, you sell out as well. So you're getting bit at both ends. And I don't think a lot of people realise that at the start because they've only got a little bit of money in there. So then when I'm talking about long term, imagine if you had a big chunk of cash in there. And then you went in and put it in and, oh, shucks, I'm getting charged a lot now. And then when you go out the other side, hold on. There may have been a better vehicle, or there may have been a better fund, So for me, trust me, I'm throwing no shade. They've done great. They've done great. But for my viewers, just be aware.
Be aware,
Go in eyes wide open. Go in eyes wide open.
Nice, that's good. And because what I've been seeing, there's been a shift, and what's becoming popular, and I'm not trying to digress or trying to move us away from the kaupapa, is that some of our people and some of my reanga particularly and younger are getting into not the Bitcoin, I'm not saying it is, like heavily involved in gambling.
Yep.
And it's become popular.
It's easy,
the dedicated
easy.
pages to slots, machines, and all of that kind of stuff. Was kei te pai. You know, if you're enjoying your nice little night out and you're having a little tap, that kei te pai tēnā. But when we're fully investing ourselves, just imagine if we invested ourselves like that into sharesies.
Yeah. Yep. Exactly. And I use the same story around lotto.
Yeah.
Everyone likes lotto, and they're going,
Nice.
"Oh, this is great. I'm going to do," and you're buying a ticket, so you're spending what now, $28
Yes.
to get a decent,
Yep.
go
Triple
at
dip.
it. Yeah, triple dip. You're spending $28 a week. Some people twice a week.
Yeah.
Now it's Wednesday, I think. So there's $60.
Yeah.
You're spending a week. Well, when was the last time you won? And how much have you won? Like really, have a think about that. Oh, I got another ticket, or I got a. If you put that $50, that $60 into a fund or into a thing and just set it and let it go, that's doing real work versus, again, gambling.
Yeah.
So I think the thing that's got us is those games and everything, making poker online and all I see it too. I do see it. It goes back to our first session.
Yeah.
Talking about allocation and money you can splurge.
Yeah.
Now, if you use that money for that becomes your entertainment. And trust me, I am not condoning gambling. Never.
Yes.
But you got to remember which bucket of money you're taking it out of. And if you're starting to creep into the other buckets of how you're living and spending your money on other, stuff that's not for the whānau, then that's where the problem starts. Okay. So I'm not going to, that's in your enjoyment, that's your entertainment, but treat it like that.
Yeah.
Don't treat it, So, but yeah, I see it too. Too.
Okay, now we're getting into diversification.
Yeah.
Don't put all your eggs in one basket.
Now that's an old saying.
Yeah.
But it actually is true, and you'll hear it in this. But my own personal story, we're property heavy. That's what we got into when Tab and I started out, and we went down this route, and then we didn't have the other side, the investment funds and those sort of things. Being diversified is the key, and there's multiple ways of being diversified now, and that's the beauty of it, right? So you can have your money into a fund that could literally have the top 500 companies in the US. That is the NZX, the S&P 500 is exactly that. Now, if that's not diversification, there's something, because you can then go in there, and then there's the top 50 in New Zealand, and you can have some in the States. So there's real easy ways today about diversifying, not just where it is. So you could have some in a term deposit, you could have some in a fund, some in New Zealand, some in the States, some in global funds. So what I'm saying again is just have a think about that, what that looks like. One might be performing badly, one might perform good. That's the beauty of diversification. They sort of back each other up, right? And we talk about this in all sorts of things, and it's a good one. Don't put all your eggs in one basket. It's a real simple analogy that we can all see, right?
Yeah.
We dropped that basket.
Katoa eggs, no more.
So just be aware of that. That's the goal is to try and smooth out the ride. So again, it comes down to your risk, your timeline, all those sort of things that we want to do. But just be aware, diversity. And it's quite easy now to do it because of the way the funds are set up.
So diversification, e te wānau, is almost like not letting one bad decision ruin the whole plan. And before we get into our next kaupapa, a massive shout out going out to our hunga wakarongo who are interested. I've just got a comment in our whānau page, Uncle, which is really good. Interested in this investing kōrero and the sharesies. So one tip, other than the one that you've already provided, make sure you do your homework, go in eyes wide open. For someone who's just starting out, what would you recommend the first step is?
Just go in there and start reading up on the funds. Don't try, for me, this is again, don't try and pick the company, put again all your eggs in one basket. You're going to go and try. Go in there, the S&P 500 is a great fund. If you get into that one there, you'll be fine, because all the big tech companies are they? They're in the States.
Yeah.
You know, like, so those are the ones making all the big ones. It's something like, it's either 70 or 80%, again, don't correct me on things, but are in the top 5 companies.
Yeah.
And, you know, that's the Nvidias, the Googles,
Yeah.
the Apples, you know, the Amazons. You can rattle them off. Those are the big boy companies. Well, they're all in those funds.
Yeah.
So you get to have a piece of that, but having another 500
Yeah.
to diversify your portfolio.
Yeah.
So, you'll if you have a look at your KiwiSavers and the investment funds, you'll highly likely have a piece of that action anyway. So
Nice.
that's where I'd start.
Yeah. Ka pai te wana. If you've heard that, that's where you need to start. Nice and simple. Remember, eyes wide open, and really going in with intention and making sure that we're doing our reading, you know, doing a little bit of mahi te kāinga as well. Okay, now we've got a Kiwi example, Uncle.
Yeah. Well, that was my thing around the sharesies.
Yeah.
I wanted us to just go and have a real proper think about what that looks like, because they have done a great job, like I said, about educating us. So the platforms are there. Trust, they're not the only platform. There's plenty of other ones out there now that you can get on and have a good look. But the beauty of today's world is we have so much information that we end up getting a little bit overload, you know, like, and how we process that information. So the key bit about having a platform like Sharesies is it is all there. It's all in the app. It's away you go. But as we know, most companies now have an app. You know, they'll have a website. They'll have a thing. So don't think you have to go and do something different if you're with a certain provider or something. Have a look at their website. Have a look around. Like, chuck it into the tools we have today. Chuck it into our, you know, give good prompts to our chats and our AI stuff, and have a look. I'm not saying use them for all your investing. I'm saying use them for information grab. And then you make the decisions on how you feel, again, your goals, your timeline, how much money you can put away. And remember, investing's about the long term. This is not a quick win. Sorry, I don't have the answer to that.
Yeah. long term game. Yeah. And it's a good reality check. Apps make investing feel easy, but easy doesn't always mean it's wise. What's one rule of thumb people could use before hitting buy or sell?
I think really test whether you need that money. You know, like, it's got to be something really urgent or an emergency. Just get the priorities right. Like, everyone's different, you know, and everyone has different things going on in their lives. So, and that's why we talk about that money when you're going to put it in, or how you're going to put it in. You talk about long term. You know, you think about that. You think about how it is, so that when you go to make those decisions of like, oh no, I really need this because the car is whakaru, and you know, like, whatever that is, that scenario, then you're making it. It's an easy decision. Yes. You know, it's not, oh, I'm going on a holiday. You know, it's like, I'm going on this, or I need this, not I want this.
Yeah. Absolutely.
So that would be my test. Is that the the risk and the reward again? If I take this out, what's going to happen? You know, you're going to not have that money invested for your future. Cool, cut by for now. That's okay. Move on. Yeah, decision.
Absolutely. And I think it also comes down to, right, if we're thinking about the long-term game, if we've done all of the buckets, and if we set up all our buckets, if we've put the stake in the ground and we've followed these steps and we've followed our episodes, then there's no reason to pull out.
That's right, because you'll have the other stuff.
Because we've already got it all.
You've got the emergency fund, you've got the things. Yeah. So, and that's the point of how we've tried to structure our kōrero, right?
So it all makes sense, right? Because, so we've set ourselves up ready for investing. All right. Anything before we go into our next break, which is we're going to get into our tips and our actions?
So I just want to make a point here, and it's a massive point with investing, right? Because it's around compounding. The compounding of interest, the compounding of time. And that's the really key, another key message of why investment funds work, because that's what happens. The money that you make gets reinvested, it compounds, and then the time multiplies it as well. So just be really wary and understanding the power, people call it the magic, the magic of compounding interest. So that was my key point I wanted to add just there in the end.
And any common mistakes to avoid?
I think we've covered a few already, but it's chasing hot tips. The bro said.
The bro said, so this is where I'm going to move my PT. I'm going to move it into here.
The bro said, this is sure thing. The other one is panic selling and downturns. You know, we had that talk about it. If you can't handle your fund dropping, and then you're like, oh no, I'm out. I can't. You're in the wrong fund. You know, like, that's a clear sign. Ignoring fees is another big one. Like I said about just knowing. I'm not saying they're bad because everyone has them and people need to make money to make their businesses work, so I get it. But just understanding what those fees are and how they impact you. This is one that I really want to, emphasize, I guess, is just not having a plan. Yeah. If you're investing without a goal or without an idea of what that money is for or what you're going for, that can be a key one. That needs to happen. So those are my big things to look out for.
Nice, Uncle. And just to underline that kōrero, this is general advice, e te iwi. This is general advice. This is general education. It's not personalised advice. You know, it's not about you. It's not directed to you, but you need to go in and do your own mahi te kāinga. If someone wants advice for their own situation, who can they talk to?
Yeah, come and have a chat.
Yeah, see, there we go. That's what we've got the man here. Uncle Rich. Okay, we're going to head into a break. We've got Nesian Mystic. Hōtaka e kia nei Money Mondays with Uncle Rich. However, it is on a Tuesday. But kei te pai tēnā, we're back providing you with that good information and that good kōrero. Kia mohio mai tātou, this is not financial advice. However, an opportunity to educate our people and ourselves through journeys of pūtea. So it is 8:37 on your Tuesday morning. Let's get back into the kōrero. Uncle, what is our tip of the week?
So the tip of the week is automate it.
Yeah, there we go, Tiwi. Automated. All right. No. What about automated, Uncle?
Yeah. So you would have heard me say this before. This takes away all the pain, right? So once you decide on what investment vehicle you're going into, which fund or whatever, the real key step here to make it successful is having a weekly or whatever, fortnightly, how you get paid, set up an amount, automate it, set, and let it go. That's where the power will happen.
Nice. And I like that because it makes a good habit to automate. Automatic. Make everything automatic. Would you suggest people start small if that's all they can manage, just to build the rhythm?
Definitely. Key point, just start the rhythm. You'll start seeing it build up. You'll start seeing it grow because we know how fast the weeks go by. We're mid-July now. So we're going to be at Christmas soon. Now imagine if you started, even if it's 5, 10, 20, whatever you can afford, you put that in there, you get to Christmas, you'll be like, that's how it works. And then we're there, and then we just let it go again, keep going. So the trick is, when you get paid, you know how much money you have because of your budget that we've got. You automate it, and then away you go.
Now, our action of the week, different to our tip. Our tip is just something to keep on the mind and keep refreshing and keep reminding ourselves. But our action is something that we need to do.
Yeah. So the action for the week is I really want us to sit down and have a proper think, like take the time to think about what is an investing goal. Yeah. What could an investing goal be? And give it a time frame. Those are the real key things. Could be something like, I want $20,000 for a house deposit within 5 years. Whatever the numbers are, whatever the goal is, whatever that. That's just an example. By writing it down as well, that makes it more powerful. Write it down, stick it somewhere you can see it. If it's in your room, your office, whatever that is for you, the trick is to do something that's meaningful for you. Don't just make it up because we said, I just want to save some money and I want to invest. You got to make it powerful for you. So write it down, give it a time frame. Give it amount, give it a goal. So that would be that's my action of the week.
That's our action of the week, e te wānau. So this week's challenge for our wānau is simple. Write down the goal, write down the time frame, and then think about whether your money is sitting in the right place for that goal. Write it down, stick it somewhere, you'll see it, and that's this week sorted. Any last kupu, any last kōrero for our wānau tuning in, Uncle?
Yeah, I think just to sort of sum up investing, it's really just giving your money a chance to grow. Yeah. That's the way we got to think about it. Is give your money a chance to grow, understand the risk and return, the timeline, the diversification, spreading your investments. Just have a think about that, and then remember it's going to compound. So it may feel slow as you start, or may feel, but as you get more money into there, the compounding effect takes over, and you're into it. Okay, so just remember that it is about the opportunity for your money to grow.
Awesome, Uncle. Thank you very much for coming in again and providing your kōrero. And if you missed last week's or any of the week's kōrero or episodes, go back and have a listen. Particularly last week's kōrero, it really connects nicely with today's kōrero, investing KiwiSaver. KiwiSaver is often the first investment many of us do, and without even knowing it.
That's right.
Without even knowing that we've had it, that we know it, that we understand it. But it can help us feel a bit more confident about investing more broadly. So thank you very much, Uncle. Have a great day on your Tuesday, and we'll catch up. We'll catch up with you all next Monday. Mautonu mai mo ngā kōrero e haere ake nei. We've got more waiata to come. Mauri tū, mauri ora, mauri oho.